Once the undisputed titan of global finance, this banking behemoth commanded trillions in assets, influenced governments, and fueled the dreams of millions. But beneath its glittering crown of gold, cracks were forming. Cracks that would lead to spectacular collapse. How did America's largest bank, once revered as invincible, fall from grace? Was it greed, incompetence, or an inevitable fate sealed by forces beyond its control? This is not just a story of financial ruin. It's a cautionary tale of power, hubris, and the fragility of trust in the very institutions that hold the world together. It was a crisp morning in Manhattan when the unthinkable happened. Thousands of bankers, financiers, and executives rushed to their offices, unaware that they were walking into history. America's largest bank, a symbol of wealth, security, and power, had just announced a massive shortfall, one so catastrophic it threatened to topple the entire financial system. Panic gripped Wall Street as the news spread like wildfire. Investors scrambled, customers withdrew their life savings, and within hours, the bank was once a symbol of American might, was on its knees. What went wrong? The answer lies in a tale of unchecked ambition and fatal missteps. The America's largest bank started from humble beginnings. Born from the aspirations of ambitious entrepreneurs in the late 19th century, initially it was a small regional institution serving local businesses and middle-class families. At a time when the country was recovering from the Civil War, industrialization was taking hold, and the banking system played a vital role in shaping America's economic landscape. With a focus on prudent lending and safeguarding deposits, the bank slowly built a reputation for trust and reliability. By the early 20th century, it began expanding through mergers and acquisitions, absorbing smaller competitors. The institution grew into a national player, financing large corporations that were at the forefront of the American Industrial Revolution: steel, railroads, and automobiles. It funded major infrastructure projects, playing a key role in transforming the nation's economy from agrarian to industrial. The bank weathered storms like the Great Depression and World War II, emerging stronger each time. By the 1990s, the bank reach had expanded globally, fueled by deregulation and the growing interconnectedness of the world economy. It became more than just a bank, offering a wide range of services and global trade finance. With trillions in assets and operations across the globe, it became a financial titan, influencing markets, governments, and even international policies. It was hailed as too big to fail, a symbol of American economic supremacy. Yet, as its power and influence grew, so did its appetite for risk. The slow, methodological growth that had defined its rise began to give way to a more aggressive, profit-driven approach, setting the stage for a future riddled with volatility and eventual collapse. As the 21st century dawned, America's largest bank found itself at a crossroads. The traditional banking model of cautious lending, underwriting loans, and maintaining a reserve of assets was no longer as profitable in the face of rising competition. The management, driven by the lure of high profits, sought new ways to maximize revenue, and Wall Street's emerging financial innovations provided the perfect outlet. Instead of focusing on its core banking principles, the bank shifted its attention to speculative ventures. Investment banking, proprietary trading, and the sale of complex financial products became its source of income. Derivatives, credit default swaps, and mortgages backed by securities offered lucrative returns, disguised behind layers of complexity. These instruments were inherently risky, but in the short term they generated massive profits. Quarterly earnings reports dazzled shareholders, and executives reaped enormous bonuses. However, this shift marked a departure from the bank's original mission of safeguarding wealth. Risk management, once a cornerstone of its philosophy, was now more about managing perceptions than mitigating real danger. The bank's senior leadership, emboldened by seemingly endless profits, became blinded to the long-term consequences of their actions. Worse, the speculative behavior wasn't confined to the boardrooms. Sales teams across the country were incentivized to push risky products onto customers, products that were not always fully understood. The institution had evolved from a bastion of stability to a machine driven by short-term gains. This hunger for profit laid the foundation for its downfall, as these speculative practices would soon backfire in the collapse of the housing market. The mid-2000s housing bubble was both the culmination of reckless financial speculation and the catalyst for the downfall of America's largest bank. For years, home ownership was promoted as the bedrock of the American dream, fueled by low interest rates and easy access to credit. The housing market boomed. The bank, eager to capitalize on this surge, began to offer subprime mortgages, loans given to borrowers with poor credit histories who were more likely to default. While these subprime mortgages were inherently risky, the bank, along with others, bundled them into mortgage-backed securities. These securities were then sold to investors as safe high-yield products. The bank's financial wizards assured buyers that housing prices would continue to rise, making these investments secure. Credit rating agencies, incentivized by fees, gave these securities high ratings, misleading the market into believing they were low risk. However, cracks began to appear in this facade. By 2007, homeowners started defaulting on their mortgages in alarming numbers. The inflated housing prices could no longer be sustained, and the real estate market plummeted. As defaults soared, the value of mortgage-backed securities collapsed. The bank, heavily invested in these toxic assets, found itself holding billions in worthless securities. The subprime crisis spiraled into a global financial meltdown. The very assets the bank had championed as secure were now the cause for its demise. The once unshakable finance giant was brought to its knees by a housing market that had been built on little more than speculation and unsustainable lending practices. The bank's over-reliance on the subprime market proved to be its undoing, triggering a chain reaction that would lead to its eventual collapse. By 2008, the bank's financial health had deteriorated rapidly. The fallout from the subprime mortgage crises exposed not only the toxic assets on the balance sheet, but the systematic mismanagement that had been brewing for years. The complex web of products which had once produced profits now became the bank's Achilles heel. As the housing market collapsed, the value of the bank's mortgage-backed securities plummeted. Liquidity evaporated overnight, and the bank found itself unable to meet its obligations. Desperate attempts to raise capital from private investors and sovereign wealth funds failed as confidence in the bank eroded. Investors fled, pulling their money from the institution, while its stock price nosedived, wiping out billions in the market value in a matter of days. The bank's leadership, having ignored multiple internal warnings over the years, scrambled to contain the damage. Senior executives who had once reaped the rewards of high-risk trading now faced the wrath of shareholders and regulators alike. In a bid to survive, the bank sought mergers with other financial institutions, but no one wanted to take on the burden of its toxic assets. The once proud institution, hailed as a pillar of American finance, was now teetering on the edge of bankruptcy. With each passing day, it became clear that the collapse was inevitable. The bank's mismanagement of risk, coupled with its exposure of the speculative financial products, had created a perfect storm. The foundation upon which it had built its empire had crumbled. What followed was a race against time as the government and financial regulators scrambled to prevent a total collapse. As the bank edged closer to collapse, the US government faced a choice: allow the institution to fail and risk a domino effect across the global financial system, or intervene to stabilize the sitch. With trillions of dollars in assets under its control and deep ties to every corner of the global economy, the bank was deemed too big to fail. The stakes were astronomical, and a collapse could potentially trigger a depression on a scale not seen since the 1930s. In September 2008, federal authorities took unprecedented steps to rescue the bank. The government arranged for a bailout package worth billions of dollars to shore up the bank's balance sheet. Additionally, the Federal Reserve and Treasury Department stepped in, facilitating emergency loans to keep the bank afloat. These measures were aimed at restoring confidence in the institution and, by extension, the broader financial system. However, this intervention was controversial. Critics argued that the government was essentially rewarding reckless behavior. Taxpayer money was being used to prop up an institution that had engaged in years of irresponsible financial speculation. Public outrage grew as millions of ordinary citizens who had lost homes, savings, and jobs in the crises saw little direct benefit. While the intervention temporarily prevented the bank's collapse, the damage to its reputation was irreparable. The government's rescue efforts were seen as a band-aid. The intervention, while necessary to prevent a wider collapse, was too little too late to save an institution from a long-term demise. Even with government intervention, the collapse of America's largest bank left a trail of devastation. Thousands of employees lost their jobs, from top execs to tellers, as the bank underwent massive downsizing. Many long-term employees had their pensions wiped out as the bank's stock price collapsed. decimating retirement funds that had taken decades to build. Customers who had once trusted the bank with their savings were left reeling. Many had invested in the bank's various financial products only to see their investments evaporate overnight. The widespread mistrust in the banking sector, sparked by the collapse, sent shockwaves across the country. People began to withdraw their money from other banks, fearing that they too might suffer the same fate. The loss of trust in the financial system became a national crisis. On a global scale, the repercussions of the collapse were far-reaching. Markets experienced downturns, and financial institutions around the world that had exposure to banks' toxic assets faced their own crises. The global economy, already weakened by the housing market crash, was pushed further to recession. The bank's collapse also sparked widespread regulatory change. In the aftermath, Congress passed the Dodd-Frank Wall Street Reform and Consumer Protection Act, aimed at curbing the excesses of the financial sector. The law imposed stricter regulations on banks, increased transparency in markets, and sought to prevent another crisis. However, the legacy of the bank's downfall was one of shattered trust, a reminder that even the largest, most powerful institutions are vulnerable. The collapse of America's largest bank was meant to be a wake-up call for the financial world. It revealed the fragility of a system built on risk-taking and a lack of oversight. The aftermath, there was a widespread consensus that things had to change. Regulators and financial institutions alike vowed to learn from the mistakes that led them to this absolute disaster. In response to the Dodd-Frank Act was implemented, bringing sweeping reforms to the financial sector. The act sought to prevent another collapse by limiting the types of investment banks can make, increasing transparency, and ensuring that large financial institutions had the necessary capital to withstand economic shocks. Stress tests became mandatory, and new consumer protection laws were put in place to prevent the lending practices. However, as time passed, memories of the collapse began to fade. Wall Street, known for its short-term focus, soon resumed many of its pre-crisis behavior. By the late 2010s, some of the key provisions of Dodd-Frank were rolled back, and financial innovations again once began to push the boundaries of risk. Critics argue that the lessons of the collapse have been forgotten and that the financial system remains vulnerable to the same issues that caused the crises. Ultimately, the collapse of America's largest bank serves as a reminder of the dangers of unchecked ambition and greed. While some reforms have been made, the question remains: has the world truly learned from this catastrophe? Or is history doomed to repeat itself? The balance between profit and responsibility continues to be an unresolved issue, and the next financial disaster may only be a matter of time. The downfall of America's largest bank serves as a sobering reminder of the fragility of even the mightiest institutions. What once seemed like an unassailable fortress of wealth and power crumbled under the weight of greed, mismanagement, and hubris. The collapse left deep scars on the global financial landscapes, and its lessons are still being learned today. As we reflect on this story, one question remains: has the world truly learned from this catastrophic failure, or is this another downfall looming on the horizon? The answer may lie in how we choose to balance ambition with responsibility, and whether we prioritize long-term stability over short-term gains.